Hi, James. So great to have you on the Tractor Founder Fuel series. Thanks for joining us.
Thank you, Jodie.
I've been wanting to have this interview for a while now, so yeah, thrilled to be able to get in a virtual room with you. We've had many conversations on panels and events and things, so yeah, it's nice to be able to, I guess, share our thoughts together to a broader group. Yeah, so I just want to kick off by asking you, just a lot of people know you, I know, but just it'd just be good to hear the James story and how you got to where you are now.
Yeah, well, so I guess I've been a VC now for quite a while. I've been in VC for about 16 years, not all of them in Australia. In fact, I spent most of my career outside of Australia. I grew up in Canberra and went to university here, did computer science, and then disappeared overseas for most of the rest of my career. I was working in the UK for a while, US for a while, China for a while, sort of floating about. I was doing various things. I was a founder myself for a long time in the US. I was a fintech founder of a business and then sort of fell into VC as a result of getting to know VCs through that experience. And I wound up at a fund called Accel, a big US fund. I was based in London at the time, so I was working in their European office. I was covering all of Europe plus Israel. And it was really that was the first time I started thinking seriously about what was going on in the Australian technology ecosystem ever since I'd left. When I left Australia, it was got almost plus years ago now, and it was pretty quiet on the ground. There wasn't a lot going on in the Australian ecosystem. It was a couple of years before Atlassian was launched. There weren't really much of a startup ecosystem. And fast forward when I was working at Accel, suddenly we were spending a lot of time in the Aussie market. We were coming down, we were investing in companies. We like Accel. We at Accel led the Atlassian, rather. We led the Series A in Atlassian back in 2012, 2011. And then we did a whole bunch more in the local ecosystem, companies like Zero and Campaign Monitor and others. So I spent a lot of time digging around and seeing these fantastic companies coming out of the Aussie ecosystem. And that's what really got me thinking about coming back to Australia. And so I came back now in 2017, joined the Airtree team then. They were in their second year, and I came back to help them deploy capital into sort of the next generation of companies like Atlassian that were coming out of the ecosystem. And so I've been here ever since. And my focus is always what it's always been, which is digital technology, companies right across the spectrum, everything from digital infrastructure to developer tools, cybersecurity, largely sort of the infrastructure and the unsexy work that happens behind the scenes in software.
Mm.
Lots of the building blocks that really makes things work in the software industry. And that was my focus at Excel, and it's continued to be my focus here. I'm on the boards of companies like Constantinople and Athena in the fintech world, in BuildKite in the dev tool world, and I spend a lot of time in cybersecurity as well, companies like Secure Code Warrior and CipherStash and Darwinium.
Yeah, wow. Yeah, it's such a great story. Amazing. And I didn't realize actually you were a Canberra boy.
Yep, born and bred. And I had the choice of sort of coming back, and Sydney was as close. I would love to live in Canberra again, but there's just not quite enough of a VC landscape down there to make it work. So Sydney was the next best place.
Yeah, that's so true. I just spent a week in Canberra last week actually, and I saw the real Canberra and I was like, wow, Canberra actually has a bad rap.
Yeah,
It's actually really nice.
yeah, we try and keep it that way.
I guess after all that experience, you really do know how to pattern match good companies now, don't you?
Yeah, well, VC is a funny game. We talk a lot about pattern matching in our world, and I think there's real truth to that. But ultimately, we're trying to back founders who are, by and large, trying to do something net new in their respective markets. And so there's limits to how far pattern matching can go when it comes to the products and the insights and the problems that are being solved. I think that if you are relying on your VC for product insight, you probably both made a bad decision, frankly. We try to be really almost anti-thematic in some respects. And we really want our founders to be the ones who are driving these interesting insights into the problems that they're solving, the markets they're solving them for, and the technology that they're using, and bring those insights to us. What we're very good at as VCs tends to be pattern recognition and pattern matching when it comes to building the plumbing and the infrastructure around a product. We can really help founders build things like their go-to-market strategy, build out their finance capabilities, their people teams, all the bits and pieces that you need to build a company around a great product insight. And so that's really where we sort of lean heavily on our pattern recognition. And I think we're very good at that. But
Yep.
we really are looking for almost pattern breakers when it comes to the product and the problem that's being solved.
Yeah, interesting. And that's a great segue into my next question, which is around tell us about Airtree and I guess Airtree's 2026 thinking. What are you looking for? What are your thoughts? How are you seeing things?
Yeah, well, we've started the original idea behind Airtree was to build a fund that looked and felt like a US fund or any of the funds that we've been working at overseas and just build that back in the Australian market. And we figured if we could be a first mover in building a US styled venture fund here in the local market, and the great companies would continue to be pumped out of this part of the world, then we would be disproportionately benefited from that success. But more importantly, we'd be able to give the founders that were coming out of the Australian and New Zealand market the fuel that they needed to get to where Atlassian had got to in the previous generation much faster, and also enable many more founders to get to that point. And that's largely played out over the 10 years that Airtree has been operating. We've been able to provide support, capital, and advice and a network of customers and candidates for jobs for the next generation of really massive global companies coming out. So companies like Employment Hero and Canva and Safety Culture and Airwallex all in our portfolio that are now really punching above their weight with the best of the best anywhere globally. And it's an incredible testament to the ingenuity and ambition of Australian and Kiwi founders that you can build businesses from this part of the world, 10,000 miles away from most of your customers, and yet go on to become some of the best businesses and the most capital efficient businesses anywhere in the world.
So yeah, it's true. It's so exciting. And of course, for those of our viewers that don't know, there's also, once you've invested, you've got all of that resources and extra support you give, but there's also all of your ecosystem resources that are open to everyone, right?
Yeah, and we've tried to be very open about everything that we do in VC. VC, I think, tends to suffer from this black box mentality, and that it's very closed off. And from an outsider perspective, sometimes it can be difficult to navigate, figure out how VC works, what's driving VC, how all the various documents and term sheets and all that sort of stuff work. And we've always tried to be very open about that. In fact, we've got a whole sort of program up on our website, Open VC, that basically tries to lift the kimono on everything that we do because there's no magic in it. There's no magic in the things that are in a term sheet. They're all pretty straightforward once you understand how they work and why they're there.
Yeah.
We've always tried to be very, very transparent about how it works because, frankly, even for the companies we don't back, enabling more people to get up the learning curve on how to build businesses
Yeah.
really helps the entire ecosystem. And over a long enough period of time, that helps all of us.
Yeah, exactly right. Exactly. It's such a good set of resources, and we'll add that link into the notes because, yeah, there's so much there. It's so helpful. And I think that's where we're really values aligned as well. At Tractor, we're very transparent. We want to be very open about everything. And the whole purpose of this even series is just to help founders understand options and understand the ecosystem and how they should think about capital, which
Absolutely. The
is,
best thing by far of working in this part of the venture ecosystem is that there's no zero-sum games. We're obviously finding ourselves in partnership with the founders that we back, but we're finding ourselves in partnership with other investors on the debt side and the equity side. We'll talk about that, I know, in a second. But
yeah.
it's very much a group and partnership mentality, which is, I think, very different to if you're investing in the public markets or even in private equity downstream from us, where it tends to be much more zero-sum.
Yeah, that's so true. I've been in the ecosystem almost as long as you, and you forget just how lucky we are with how collaborative and open and helpful everyone is versus other industries. And
Yeah. Well, it has to be. Building a business is one of the hardest things that anyone can ever do. It's one of
yeah,
the most grueling professional things that you can do
that's right.
as an individual. And so the support network that you need to bring around it, be it debt, be it equity, be it support, be it advisors, is
Yeah,
so fundamentally important.
yeah, exactly. Takes a lot of crazy to even think about doing it.
The
Yeah.
right sort of crazy.
Exactly, exactly. And I think from all of us to our core, we just want to see Australia grow and be innovative and be able to export many things. So we've all got our hearts are all in the right place. And
Oh, it's a huge driver for all of us at Airtree. And I know so many people in the ecosystem. And that was one of the best things about coming back and doing this. I love this job. I love this job when I was working in the US. I love this job when I was working in the UK. But coming back to Australia and going to do the job I love in an environment where it can really make a difference to the overall economy. We are in desperate need, both in Australia and New Zealand, to sort of drag ourselves
yeah,
out of an old world economy, kicking and
yeah,
screaming into something
yeah,
more creative and innovative. And if we can
yeah,
play a tiny part in that, I feel like I'll really
exactly.
have done an exciting career path.
That's exactly right. Exactly. Yeah. So let's get on to the types of capital, and we've had some friendly, not arguments. I would just say a healthy debate maybe on different types of capital. Mostly as fun because I think we both appreciate the different. I appreciate where VC definitely plays a role, and I know you do as well for where we play. So we often do get founders though that actually before they even talk to us, they say to us, but if we took some debt, would that mean we couldn't get investment again from VCs or other investors? And I know we have many companies that we've both invested in. And so, yeah, just love to talk about that and get your view on, as one of the most prominent VCs in the country and investors in the country, how do you actually see when founders have taken debt or have debt on their balance sheet and you're looking at them as an investment?
Yeah, well, I think I've lost track of how many companies we have,
Yeah,
mutual companies in our portfolio, and many of them have come to us first, and then we've encouraged them to go and talk to you guys to take on debt funding, and many have gone the other way around.
yeah,
They've been part of your portfolio and then went on to raise venture financing from us.
yeah,
And I don't think there's any firm patterns whatsoever. I think that the two funding structures can be extremely complementary, debt and equity, particularly for a company that is in a scale up phase that has sort of found a good level of product market fit. The mix between debt and equity can be very powerful. And just to give you a little bit of the background of my experience with debt and equity, when I came back to Australia, I was surprised, this was almost 10 years ago now, I was surprised how little venture debt there was available in the Australian market. And I suppose it makes sense because it tends to be one of the sort of the later things that evolves in our ecosystem.
yeah,
First, the startups come, and typically then the equity investors set up, and then downstream of that, the venture debt providers tend to come in. But at that time, there was very few options for venture debt. Now, compare that to where I was in the UK and US, I'd say that probably at Excel, probably a third to a half of our companies in our portfolio at sort of Series A and above had some form of venture debt on their funding structures. And it was much more common in those more developed ecosystems to use debt as a tool to extend your runway, to enable you to scale your go-to-market and really drive returns for both the founders and the equity investors in your business. And so coming back to Australia, I was a little bit surprised that it hadn't got there, but I've been really pleased that the market has evolved a lot and there's many more options for founders because there's various ways that you can fund an early stage startup, and oftentimes a combination of them can be the most effective way. The high level way I like to think about it is equity is a great foundational layer to your the technology venture. It enables you to run the experiments you want around trying to get to product market fit. It is a intentionally high risk asset class in the sense that we invest in a portfolio of companies expecting that many of them won't be able to achieve the breakout success that many of the founders had in mind. And that's absolutely okay. There's lots of founders in our portfolio that we seed the very early stages of their business. In fact, probably 80–90% of our investments come in at that first check, come in at that very early stage when oftentimes it's just a founder and an idea. And those early checks are equity checks that enables them to go out and run the experiments that to determine whether or not they can build something that their customers really want. And by the stage they've done that, they've usually got a really nice equity foundation that enables them to start thinking about taking a product that has product market fit, or at least the early signs of product market fit, and starting to scale that. And as they start to understand that go-to-market motion, as they start to understand the economics of selling that product, that's when debt can really come in handy. And it can come in handy in a number of ways. I'd say that the first and most prominent way is when it comes in alongside an equity check. And I'd say that most of our companies, on our suggestion, consider this when they're raising, say, a Series A or a Series B. Oftentimes we'll raise an equity check from us and other investors who write equity checks. And alongside that, we'll do a tranche of debt. And the reason we often do that is because it gives the company more runway to get to more milestones and de-risk more of their go-to-market proof points so that they can get to the next equity round. They can push out the need for the next equity round even further.
yeah,
And that can be an incredible way of, it's a low cost of capital relative to equity, and
yeah,
it can be an incredible way of optimizing the value of the equity in the business, both the equity owned by people like us, investors like us, and most importantly, the founders themselves. So that could be a really effective way. Another one is for a company that hasn't yet decided whether or not the venture pathway is the right one for it. And that can be a whole number of reasons for that. You could have a great business going after a small market where it doesn't quite make sense to get on the venture capital treadmill. And in those cases, when you might be experimenting with a great product in a smallish market to try and determine whether or not the actual market size is bigger than you think, debt can be an incredibly powerful way to take that in and of itself without the equity check alongside it, just to run some experiments to try and figure out if you've got a larger market to go after. And then if you decide you've got a really big market that would lend itself to a big venture financing round, an equity financing round, then you can go off and talk to people like us. And we love those sort of situations.
Yeah, brilliant. And I really love the word experiment, and I talk about that all the time as well. And we sort of talk about when, for us, where it really works, founders know they're onto something. So they've done some experimenting, they're through some of the experimenting, and they know this thing works. And so
Mm.
they know if they double down on feeding that ad machine, putting on those salespeople, they're going to grow their revenue. When it's known and they're confident, that's when debt really works well. When they're
Yeah.
experimenting, that's when it's riskier, and you need that sort of higher risk type of capital. So,
Yeah.
yeah,
Equity is great for learning and building the machine, and debt can be a really smart way to just put fuel in that machine that's already working.
exactly right. Exactly right. And we do see that a lot as well. When you know you're onto something, you want to grow those metrics, do that first before you go and take out another round. I think you said exactly that. And because as an investor already in the company, you want to save your dilution as well.
Mhm.
Makes sense.
Yeah, yeah. And I
Yeah.
would say you asked a question about whether or not how we look at companies that have already taken debt when they come and talk to us about equity rounds. Usually it's not an issue whatsoever. There's always mistakes you can make. Talking to the wrong debt providers, there are definitely in the Australian market effective loan sharks out there preying on. I'd certainly not put Tractor Ventures anywhere near that category, but there certainly are people, just as there are bad actors in the equity side. I would say just as many times when companies come to us and they've got messed up capital structures, just as many times as, in fact, more times it's because they've taken equity from the wrong people on the wrong terms than it is taking debt from the wrong people on the wrong terms. But it certainly happens. So I would encourage all founders to really reference check the partners that they're working with, both on the equity side and on the debt side, because it really is
Yeah.
an important pathway.
Yeah, that's a very good point. And I think I fell into that in my first startup myself. I was in shark territory and
Mm. We see a
yeah,
lot less of it these days. 10 years
yeah.
ago, it was amazing. Some of the stuff we would see in term sheets on the equity side and on the debt side was
Mm.
something that we felt had died out in the dark ages of venture capital, but they were still floating around in term sheets in Australia 10 years ago. Fortunately, we don't see too many of them these days.
Well, yeah, coming from more sophisticated markets for you, you would have that would have been a
Mm.
shock. Yeah, yeah, awesome. Well, thanks so much, James. It's awesome. My thing is with this just to communicate and educate. And the big thing is for, as you said, think about what is the journey. And I talk about this a lot as well. Where do you want to go on that ride to the moon? Or actually, do you want to have a business that has a smaller exit that just you're something that you're passionate about and that change that you're making?
100%. Always happy to help. And I think our job as a VC and your job as a debt provider too, Jodie, is really just to help founders just compress decades of company building learnings into a few intense short years at the very beginnings of their journey so that you can sidestep so many of the mistakes.
Yeah.
And figuring out the right capital structure for your business is just one of those learnings that's important in your first couple of years as a founder. And so anything that helps shortcut and get people up that learning curve is incredibly important. We're happy to do it.
Yeah, that's brilliant. Thanks so much. And yeah, I guess for founders listening, go and talk to all the people, go onto the Airtree open source and learn as much as you can. And we're here to help you avoid the mistakes that we made.
Yep. And reach out direct. You don't need warm intros to get in front of us. We love meeting founders all day, every day. So please do
Yeah,
get in.
great point. Awesome. Thanks so much, James.
Thanks,
Appreciate it.
Jody.